Good morning, everyone, and welcome to the 114th episode of the Veritas Fact-Finding Series. And today, I'm joined by my longtime friend, Scott Terrio. Morning, Scott.
Thanks, Anthony.
In each episode of the Fact-Finding Series, we go on the ground to speak to industry professionals in an unscripted, candid, live video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. If you're watching and you like what you hear, subscribe, give us a like, and follow us at veritascorp.com. By way of background, my name is Anthony Scilipoti. I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada. And I'm proud to say this year we celebrated 23 years, 100% employee-owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants or employees of the Veritas group of companies may own securities discussed in this broadcast. While we love all our guests, and Scott Terrio, of course, most, this session may contain forward-looking statements, investment opinions, and comments that we may not agree with at all. Now, I'm going to find that hard to believe with Scott, because it's all going to be supported by facts. That's the best part of what you're going to hear today with Scott. Now, if you haven't heard Scott, we had Scott on here as one of the first 10 fact-finding guests we had back in 2020. We're all locked down in COVID. CMHC is telling us that house prices are going to fall 18%. Central banks are trying to deal with low interest rates at zero and what effect that's going to have. That wasn't enough. They're cutting checks to individuals. We saw a period that I think neither Scott or I have ever seen in our life, and we have to go back 100 years. But even this pandemic is much different than the 100-year-ago pandemic. Anyway, Scott is at Hoyes, Michalos and Associates. He has 14, 15 years experience in the insolvency industry with a background that extends into sales, marketing, and business development. He brings a wide skill set when he advises clients on what to do with their financial situation. And I'd like to give this pitch for Scott, having known him now for a number of years. He is probably the most sought after individual when it comes to finding out what's really going on the ground with the Canadian debtor in Canada. So, Scott, thanks for joining us today.
Thank you very much, Anthony.
So let's start out. I mean, 20,000 feet. Inflation's eased over the last 5 months. Rates, and you spoke at our real estate conference last year in the first week of October, rates were sitting at 3.25. Today, they're at 5. Basically, what's it like out there in credit land? And what are you seeing for the debtor?
Well, so this has been a heck of a 12 months, hasn't it? Interest rate increases, number one, and they're starting to really kick in and be real for people. That takes a bit of time sometimes, but it's certainly 12 months is a good taste. Inflation, generational inflation. There's a lot of people out there who've never known inflation. That's starting to bite. People are living paycheck to paycheck. There's a lot of studies out there. You can in a quick Google search, you'll bring up 10 pages worth of that stuff, and how many Canadians are in that situation where they can just pay what they've got, but they don't have room for any more. And that is starting to not work as well for people because of the two things that we just mentioned. Banks have switched from lending to aggressively collecting. So, major bank contraction, to say the least. We have front row seats for it, of course, because in 90% of our files are consumer proposals where the banks vote. We offer them a settlement and they vote on it. So we get to see what kind of mood they're in. And, they're not in a good one. CRA is on the warpath like I've never seen in my 14 years of involvement with them. And people don't talk about real estate the same way now as they did a year or more ago, Anthony. So the mood has switched from the great Canadian pastime.
And so how are they managing? How are they making ends meet?
Well, various ways. I mean, the Canadians are very resourceful, okay, especially when it comes to their debt. they can really make things go for, a much longer time than you'd think, I think, from the outside. The number one thing is they're doing multiple jobs. So we have a gig economy here that is very real. I can't tell you how many people I meet with who are driving Uber on the side, like they might be a university professor or I don't know, a bank employee, or like, it doesn't matter what they are. But trying to make ends meet. You said, how are they managing? Well, they're managing with extra jobs. And the issue there is, well, first of all, your health and your stress and your family toll that it takes on you. But also there are very practical considerations about that. Like if a person has 2 or 3 part-time jobs, they only get taxed at a level of the individual job, because that employer is saying, well, here's how much you're making. And CRA has a problem with that, okay? Because you're actually making 3 incomes and CRA is taxing you on the 3, not the 1 each. So you're actually getting under taxed oftentimes. And so the back end of that situation is that people end up with a substantial tax debt on top of everything else. And of course, nobody told them that. CRA doesn't tell you that until it's time for you to pay them. So, and really what the biggest thing they're doing to manage is they're resorting to credit usage. And you can see it in the credit card balances data that has gone up dramatically, which is exactly what you'd expect to happen. When you're paying a lot more for groceries, for housing, for gas, and for just about everything else, and your mortgage went up, and your lines of credit went up because of interest rate increases, then it's got to come from somewhere. And, people are getting by often by resorting to credit, or at least the people who still have credit limits to do so.
And so why aren't we seeing insolvencies?
Hey, I'm working on it, man. I'm doing
Your
my
business
part,
should
okay?
be exploding.
I was up till 10 last night working on that. I have been asking myself that for 14 years, Anthony. Why are we not seeing more insolvencies? The answer is that we're not yet seeing more. Actually, the numbers have gone up. We predicted 20 to 30% increase in insolvencies, consumer insolvencies this year, and we are still in that range. But what you're seeing here is there's a lot more homeowners that are being affected by what's going on. Interest rates hit homeowners mostly, and homeowners have a lot more runway when it comes to filing insolvencies than renters do. It can take 2 to 3 years before we see a homeowner after the time that they've realized that they can't do this anymore. So that's number one. Is this next insolvency wave is going to play out over 5 years because of what I just said. Also because, as I'm sure all of your viewers and listeners know, not everybody's mortgage comes up for renewal at the same time. So you're going to have a few a year, a few a year, a few a year. And as that happens and they realize that the payments go up, now this might be mitigated if rates go back down, but I think for a lot of people, it's already happened. So it'll take time for all of that to show in the insolvency data, even though we're seeing 20, 30% increases already, because, as we'll see steady waves as mortgages renew and as people get hit with that stuff. And also we will see more insolvencies if we see more job losses. Job loss, that's the one leg of the bar stool that's still standing, I think, in this economy, is that we are not yet seeing widespread job losses, although the banks and some others have done some recently. But people are kind of in a holding pattern. Like a lot more people are filing, but a lot more people are still waiting, because I think the last decade or 12 years of, near zero interest rate policy has made people, I think, vulnerable to a sense of, security, and that they'll be saved. And I don't know if that's going to last. I mean, interest rates went up a whole bunch of times in a short period. And it depends if rates go back down, but stay relatively high for a long time compared to what they were during the boom, then you might have a lot more problems. What is not visible to people is what I see every day, which is the number of new potential clients we're meeting with, which is a lot. Like we are seeing a lot more new callers than last year, even than earlier this year. And that fills the pipeline. So, if I meet with 40 people a week instead of 20, and we have 25 offices across Ontario and we do 3,500 files a year, you can see, and we're one trustee. So, there's hundreds of trustees. So, and all of them are getting busy that way. So the pipeline is really filling in the background, and there's no data that would show that other than internal. And so, if I'm meeting with all these people now, and our firm and other firms are meeting with all these people now, they're not filing yet, but they will file. Some of them will file in the next 30, 60 days. Some of them will go away and come back.
And it's interesting. I know we've talked about this before, but I think it's good to flesh this out. An individual comes to see you, a renter and a homeowner, and there's a two discussion because there's two Canadians here.
Yeah.
And both of them come to see you day one. What does the life cycle for each of those humans look like between day one meeting with Mr. Terrio and actually coming to see you, waving a white flag?
Well, my dad is Mr. Terrio, by the way. So I'm just Scott. So renters will file fairly quickly just because they don't have all the resources that homeowners have to go and fix their problems with accessing home equity, refinancing. Also, when you own a home, it's a lot riskier to do something in your mind, right? Because you have this massive lifelong asset. And I think it stays people's hands a bit more. You're not going to lose your apartment if you file a proposal. Now, in a proposal, you don't lose your house either, but we factor in, your house's value and all that stuff. And so I think people tend to think that I'm not going to do this just yet as a homeowner. So homeowners, look, I've got homeowners that I've met with in the last 6 months that are filing now or have filed already. I have people who bought pre-builds and walked away and lost their deposit, and they're getting sued because their appraisal came in at 200,000 less. So that's all happening right now. And those types of people are filing right away. Homeowners who have equity can probably talk to us, get some advice, go away and think about their options. And maybe they come back in 6 months, or maybe they come back a year or two now when their mortgage renews and their payments just went way up. Does
it happen that, of the 100 people that come to see you, renters, homeowners, what percentage end up finally filing?
Great question, as always. Probably about 50, 40, like more than half don't file. Okay, because there's all kinds of reasons. Like if you phone us, you're not entirely sure what you need to do. And I always say that people should seek help earlier when it comes to this stuff, because your options diminish as time goes on. Like time is not your friend with debt. Okay, everything gets worse over time with debt. And so, yeah, if I meet with 100 people, probably 40 of them file over time. Maybe 20 file soon, another 20 down the road, but 60 don't, because either you got too much equity, and I say to you, look, you could do a proposal, but you don't need to do this. Okay. Some people are creditor proof. Like if you're on a Canada pension, and you owe 50,000 in credit card debt, those creditors can't touch you. They can't take you to court and successfully sue you because they can't touch your pension. So when you tell them that and you say, just stop answering your phone, change your phone number, get a new bank, you're safe. So there's a lot of people who call who are not essentially eligible to file. So there's a whole mix of people that we talk to, but yeah, it's only probably 30, 40% that actually file. So what we're doing is giving them really great advice for no fee. And they walk away and do whatever they're going to do.
But if you're saying the number of calls you're fielding today versus last year are up how many fold?
Oh, probably 20, 30%. At least.
So they're up 20 or 30%, and half of those is going to file. You had half before, so you're up another, 15 or 10 to 15%.
Half of them will file, but not all of them will file in the next 30 days kind of thing, right? So there's a group that will have to file like right now. We have all kinds of those all the time. Yeah. Because it doesn't make sense to wait, right? Like you're not, waiting 6 months is nonsense. We file soon, but then a bunch of them will file eventually, and then a bunch of them won't file at all.
So what are you watching that would change your outlook?
Well, so I think rates are a big thing. This country is, look what happened when rates went up. Like the entire atmosphere in this country changed, right? Nature of conversations changed. The discussions going out with people socially has changed. Everything in my mind, everything was rates. It was, maybe that's an artificial economy, but if rates drop rapidly enough and substantially enough, and over like a shorter period of time, I think the mood will change a lot, because I'm seeing all kinds of people saying, hey, it's time to buy a house because rates might go down. Like, might go down, like that's a time to get excited. Again, the job losses. I think if we end up with a lot of layoffs, it's very hard to fake your way out of a job loss. Okay, even if you get a severance, when people call me with a job loss, they're screwed. Like, it's just, that's too much to take for a household. I just published a thing on my new Substack about life events. And that's one of the events that is like a sledgehammer, right? And so if we get a lot of job losses, I'm watching the employment data. That'll be a huge thing. I think if the employment stays reasonable and rates come down a little bit in the next year, I think the mood will change a fair bit, despite all the other things that are negative.
But if rates, I want to flesh out the unemployment, because you being on the ground talking to people, okay, you're hearing the headlines, Rogers cut and BMO cut and Royal cut a single-digit percentage, and so it's percolating, right?
Yeah.
And yet we're seeing that our unemployment rate now, it's up from 5 to 5.7, but it's still, multi-generationally low.
Absolutely.
So how is this possible that, you're seeing an increase in filings, not so bad yet. Companies are laying people off, but we're not seeing it in the numbers.
Yeah, because people, again, we're back to the living paycheck to paycheck thing, I think. The employment, a lot of people are still employed, but it doesn't mean they're doing well, right? And, if you've over the last 10 years or 15 years always had credit limits available to you, the credit utilization factor in credit reporting, they're tapping those now, and they're not tapping them for trips, right? They're tapping them for necessities, and that's a big difference, right? I think people are using their credit cards for groceries, for gas, and they're not paying them back because they can't. So I think the big thing is, yes, people are working, but that masks a lot of the consumer household health, I think, issues that are going on for real on the ground. One thing I would also look at or watch, I guess, as an outlook, is people selling their homes, right? Like right now, a lot of homes are just not being sold. I'm sure all your listeners know. People are just holding, waiting, right? Because they don't want to get out of the market in case there's something coming, whether it's rates, whether it's a magical, whether it's a bailout, who knows, right? I think people have all these ideas that, again, we're back to, 12 years of free money has made people a little soft in that sense. They expect, right? I think there's an entitlement mindset. So I would watch to see when people actually really start selling their homes, because that's something they don't do, even if they're in my office traditionally. So if you see homes starting to sell and list, and people are willing to, take what they get. Like I saw a comment from somebody recently saying, homes are going no bid. Well, yeah, like that, bidding wars are not normal. I realize they got that way. So I think that kind of stuff is going to be very telling. The jobs, the houses.
This is something that we're very focused on and have been publishing, and came out of our real estate conference, is looking at the months of inventory, which has turned up. Okay. But my favorite stat is looking at the number of listings to housing stock. And if you all you need, like we're sitting at about 5.1% right now, a disaster, which we haven't seen since 1990, early 90s, it was at 7.3%. So all you need, you take your local area, there's 100 houses. If 2 more houses go for sale, we're in a situation where it could tip very ugly.
Yeah.
And
I think you're right about that. And you can hear that in people's conversations. You know, like when I'm at the school or whatever, and like, you know, almost everybody in my neighborhood is a homeowner, but like none of them are rich or well off. They're just working people who, you know, have good jobs, but that's it. And like, you know, the conversation, if because several houses have gone up for sale, and people notice that, right? Because it's their neighbors, right? It's
Yep.
people that they know. And then they start talking to them and they're like, yeah, well, I mean, our mortgage payment went up like however much, like a lot, right? And everything else is the same.
Yep.
Nothing else has been cut or reduced. And oftentimes it can't be, right? Like, it's not like all their kids are in private school. That's not how our neighborhood works, you know, but like all these people are, I don't know what you would cut to make up for a massive mortgage payment increase. Like that's, you know, and throw inflation on top of that. So I think you're right. Like it won't take much. Housing is very psychological, you know, especially in this country. Like, you know, we're the masters of it in Canada, right? And like for a while there, I think it was Australia, but I think we took over. But we're very twitchy about housing, you know, and it doesn't take much, like you said, for, you know, for a mindset to set in that would freak people out.
So what would you advise Canadians that are struggling with their debt that come to see you? What do you advise them to do?
Well, I put it all in crypto, baby. That's, you know, if you like
Crypto and cannabis.
Yeah, if you're missing that boat, boy. No, you know what? A few things here, okay? Number one is never be afraid to sell your home or your condo and exit the market. Like, there's so much fear of that. And I've seen people, and I say this because I've seen people do it and get back in when they're in a much better financial position to do so. It might take 5 years, okay? But if you're 30, who cares? You got 40 years left in the marketplace, for Christ's sake. You probably got 40 years left in the workplace.
Yeah. And
I think I tell people I'm not telling you to sell your house, but if selling your house means you get rid of this, and this problem, and then 5 years from now, you have no debt and still a good job, two of you, I don't think there's any reason to be overly fearful of getting back, of, you know, the FOMO or the FOBO, the fear of getting out. So that'd be one thing I do tell people, and no, they don't always sell them, but don't think that you'll never ever get out of it. Another thing I would tell people frequently is downgrade your damn car. You know, I did an interview yesterday about cars, and one last week about cars, and cars are kind of the silent killer in finance in Canada. It's not an appreciating asset over time. It's not something you're going to leave your children. It's not something your parents are going to bequeath to you or use the equity in their car to buy you a house. Like, people are weird about their cars. And like, I say that because I see some real disaster situations. Like, it's nothing for somebody to, first of all, when I ask them how much their car payment is per month, they tell me the weekly amount or the biweekly. They never tell me the monthly, ever, never. And I say, is that weekly? Oh yeah, weekly, 150. Okay, so it's 600 a month. Yeah, I guess it is. Like, it's out of their mind. And the car industry has done this to us for 30 years. Okay. So consider downgrading your damn car. Change banks if the bank you bank with, you owe money to. Just trust me on that one, okay? And I can send a link to people out about this, you know, the right of offset. Stay off YouTube and Reddit, for God's sake. That's advice I tell people who are struggling, because it's easier to stay out of trouble than it is to get out of trouble. Prevention is huge. With some moves that people make in terms of finance and personal debt, tax, all that
because
stuff.
the individuals that are there are leading them astray, or giving bad advice, or
yeah, there's too many experts. There's too many self.
Oh yeah,
I see it. Right?
Advice is as good as what you paid for it.
Yeah, or else, you know, I always my line is always, my brother-in-law, the cop, told me blah blah blah, and I like, you know, and then I have to undo the problem, right? Which takes a lot more. So just watch who you're talking to and who you're getting advice from. And the biggest thing is, again, get help sooner. If you're in a financial pickle, whether you're a homeowner or renter, doesn't matter, whether you're a self-employed business owner, whether you work on payroll, whether you're married, not married, whatever, people who call us sooner can do a lot more than they think.
Okay.
In fact, our data shows that from the time people realize that they're in financial trouble that they're not going to get out of until they call us is 12 to 24 months. That's a long time. And in that 12 and 24 months, things get a lot worse and they never get better. And so if you call somebody sooner, again, like 60% of people I talk to don't file with me at all. They just get good advice. Okay. So, or anybody, you don't have to talk to a trustee, but talk to somebody who knows what they're talking about and do it sooner. Because that's a big deal. Time is your enemy with this stuff.
So we're going to dig in now, pull this all together, who's most vulnerable in terms of the cohort of people and what is the potential outcome for them. And then let's look at which lenders are vulnerable. And just a reminder to everyone, if you look at scroll over the bottom of your screen, we are live here. So I will make sure that Scott addresses your questions. So if you have any, please, by all means, give us. So let's start with the cohort of the population.
Sure.
Scott.
Well, so this won't be a surprise very much, but young people are in a hell of a situation right now. Millennials and Gen Z. It's hard for me to see a good outlook for these folks. They've come along on the back of a housing boom. Affordability is not affordability. And a lot of jobs are, as I said, gig economy, or you're working a full-time or a career job, but you don't have great benefits. All the things that a lot of us enjoyed are not there anymore for people. I would hate to be coming out of university. I mean, look, I came out of university in the teeth of the recession in the 90s, so I at least know that. I think it's worse now. Cost of living is a killer. Cost of housing is a killer. The career jobs that don't exist. And the generations preceding millennials and Gen Z got rich and pulled up all the ladders, right? So it's like everything's stacked against people right now. So that is a cohort that I see is in big trouble. And I think, a lot of them are trying to go entrepreneurial, which makes sense and which is commendable. I just don't know if we have the kind of business or tax culture in this country set up for that. It would be nice if we did, because I think we'd be better off as a country and certainly as an economy if we were a lot more entrepreneurial than we are. So they might do that by force or by necessity. And I also think it's not a cohort in terms of age, but people who don't have family support are having trouble. And there's actual data on this. If your parents didn't own a home, if your parents owned a home or own a home, you are 2 to 3 times more likely to own a home in your lifetime than those whose parents didn't own. So it's almost like a curse of birth, and it's not, you can't. It's a lot harder to overcome being born not well off and becoming well off than it was, say, 15 years ago, and that's sad.
But this shows also all the studies where those that are on social assistance, they're in the social assistance spiral.
Yeah.
Like children fall into the same trap. Yeah. And it's very tough,
very hard to break out of. And even like I said, if we had a better tax scheme for entrepreneurial activity, that kind of thing would be different. Because I think a lot of people who are coming out of school who've never had the kinds of career jobs a lot of us enjoyed, because they don't know that, they're more likely to try something themselves anyway, which is good. They don't get comfortable in a career job for 10 years and then at age 35, do you really want to start your own business? Probably not. But at age 25, maybe, right? You don't have a lot to lose, right? You got a lot more energy. Yeah. Maybe not the capital, but that can come with a proper, tax scheme set up and other things, right? But I think we need to get there.
So let's flip the other side. What about lenders? Who you see being vulnerable here?
Okay. Among the big banks, the ones I see with what I would say is the most risk exposure on credit cards and that kind of thing is CIBC. Big shock, big horror, I know. I would also put BMO in that list. Now, no big chartered banks going out of business in this country. We know that. Okay, but that doesn't mean they're not going to have a rough time. So I think CIBC is a no-brainer for me. BMO would be my, if I had to pick another one on there, I'd say BMO has got some exposure. Secondary lenders right now have got to be hurting because people typically have their big bank debt and then they get these. So from a chronological standpoint, having met with, I don't know, 12,000, 15,000 people about this, they always have their bank debt, CIBC credit card, RBC credit card, whatever. And they probably inherited their bank from their mom and dad anyway, or got it, when you go to a frost week at university, there's 5 tables there, right? And they're all trying to get you for life. So whichever one you picked, but the secondary lenders got to be hurting because they don't lend as much, but they lend at higher rates and they lend to riskier people. Simple. And when it comes to mortgages, secondary lenders are usually, second or third on the list when it comes to equity, right? So, I'm seeing that now. Like we've had a number of situations where secondary lenders, certainly private lenders, if somebody gives their house back to the bank, well, the big 5 charter bank is covered, right? But because equity went down a bunch in the last 2 years, there's no more equity for what the secondary and the private lenders lent on. It's gone. Okay, so they're out of luck, and that's usually a big number. When it comes to the secondary lenders, Canadian Tire have always been kind of shocked at how much lending they do to people. And when I say that, I mean like, a $20,000 credit card and another one, to somebody who already has 30, 40,000 in credit card debt, and they know that because it's on the report. And they're, doing a modest job, no house, like it's, I just think that those guys, and of course Scotia got out a while ago, I'm sure you all know that, so kind of on their own now. So I imagine Nigel's been busy. Ironically, so we're seeing a phenomenon which I think I've mentioned to you maybe before, but installment lending. So these, we call them rapid loans. So these 5, 10, 3, 5, 10, 7,500, 10, 12, $15,000 loans. Okay. And I'm not going to name them. You can call me if you want on it, or you can email me. I'll tell you everything you want to know, but these have proliferated in the last 5 years or less. And there's reasons behind that. Now I'll get to those in a second, but these are 48% loans. And this is 12 points below usury. Okay.
Yep.
12 points shy of being illegal. And people have resorted to these out of desperation. So this kind of economy is what drives this stuff too. So there's been 2 things that have driven this proliferation. One was the very ham-fisted attempt by the Ontario government back in 2000, and I'll have to look that up, I'm sorry, where they tried to crack down on payday lenders, Anthony. Yep. Whoa, man. And what the payday lenders did is said, okay, great, we'll just start lending non-payday loans. Technically, they'll be installment loans, and we'll charge 48%, and we'll make a bundle off, and then they're doing that. Now, the issue with them, though, is when it comes to a period like the last 6 to 12 months, where people, these are usually the last loans they get, okay? So in the cycle of a consumer debt, our typical client has 50,000 in credit card, whatever debt, unsecured debt. Homeowners about 70, 75,000. But of that, these are always last in chronological order. Okay, so some event or whatever, or desperation has driven you to go in and get a $10,000 48% interest loan, which sounds biblical. And
it's sad. We laugh, but it's very sad.
Well, I laugh because it's sad. What else?
And they're advertised. They don't advertise. You got to be able to do math to get to the 48%, because they just say you're going to get this much money, and all you have to pay every week is X. Correct.
Because, what I do is I say to them when they send me the statement, or when they put it on my desk, I flip to page 2, and page 2 actually lays out the actual schedule where it says 48%. So people have the idea that, so what they're doing is they're borrowing 5,000 and they're paying 6,000 for the cost of borrowing. So it's 11,000, 6 of which is interest. And nobody has a problem with this. So I think this is a much worse problem than the payday lending problem that they tried to tackle and inadvertently drove. The other thing that's happened is it's gone online. And I can tell you that it's a hell of a lot easier to get a $12,000 loan sitting on your couch at night with your laptop than it is to walk into a big sign, yellow sign place on a main street where everybody can see you go in, there's bars on the windows. Like that's a major barrier that's been dropped to this. It's like the gambling ads, you know.
Yeah, and that could be being done to pay off a gambling debt or chase a gambling loss that you gotta make on the next play, and they even pitch it that way. It actually, it's making me angry. I'm gonna get angry. But we haven't seen, like, there is one public institution that you didn't name, but that does that. And we're not seeing, like, we're seeing record numbers from these institutions at the current time.
Yeah, so it's a problem. I ran away a little bit on that one, but you asked me about lenders. But
okay,
I think when our next Joe Debtor study, that's our annual study on our clients who file, it comes out this coming February for 2023. And I think one of the big things you're going to see in that is these installment loans, because they've, I know just from daily experience that they're getting very common, and they are not something you can get out of.
So let's try to pull this together. If anybody again has some questions, please feel free to ask them. I'm going to just launch our poll here so everybody can tell us what a great job you did, Scott.
I better not vote, I just came up on my screen.
Yeah, it comes on yours too. You can cheer for yourself too. But what I want to get to now is, I know you got some slides you want to show us and so forth. So let's look out 12 months. What's the world look like for Scott Terrio's world? Yeah.
So, well, the insolvency field is homeowners who had variable rates and very heavy HELOC borrowing will be in serious trouble, because they will have already been impacted directly and tangibly and monthly, and everyone lives monthly. So they're going to have already had a good amount of time under their belts here where their payments have gone up substantially. Okay, so they're going to be in trouble. A lot of homeowners who held out by not selling will have to sell. Like that's gonna crack at some point. Like I said, I'm seeing it anecdotally in my neighborhood, but and people who call us, right? Like there's a substantial less reluctance to just have the discussion about selling, whereas before nobody even called us homeowners. Like forget about having a discussion. They didn't phone. The second wave of homeowners whose variable rates crush them will be in serious trouble. The second wave of homeowners whose mortgage renewals are coming up will be in trouble. So that's in the next 12 months. We'll see another group of people who are renewing. Now with rates, again, we're back to what happens to rates. If they go down a lot in a hurry, well, maybe a lot of these people get taken care of in another way. People who thought mortgage fraud was just part of playing the game will find out that you can't fudge cash flow, just like with businesses. I'm going back to a bit of accounting here, but when your mortgage payments go up a lot, the fact that you got a 10-to-1 ratio mortgage is going to start to make more sense to you. Hard to fake that. Amateur landlords, I think, in the next 12 months are going to start to get hurt a lot with their second properties. We've had them call us already. I'm not even waiting for that. It's already happening. As I said, pre-build buyers who didn't close because their appraisals came in way the heck less than 3 years ago when the build started. They'll be filing. They already are. And there's a lot of that out there, I think. Yeah, that's a hidden.
And we remember in our housing conference or real estate conference, we had Ellis Don come and tell us how they were shocked that the majority of buyers were investors. Mm-hmm. And this is now, we're talking 2018, 2017, and that most of those investors were local Canadian mom and pops that took HELOCs on their house and bought that second, third property.
Yeah, it's normal people. That's what is the worry, I think, is that if that's who got into that, then that could be like I said, a bit of a minefield. I think people are gonna, over the next 12 months, learn the true difference between a 0.5% interest rate as a low interest rate and rates that are more like 3 or 4 that are also low. Like one low is not the low you thought. And if that sticks around for, a year, 2 or 3 years, it's going to be a lot of people whose notions of borrowing are going to be rendered obsolete. In the next 12 months, renters will have another year under their belts of having to resort to credit usage, because we're seeing that, credit card data in Canada, which I'll show you in a bit here, is at a record high. Job losses, again, we're back to that big one, right? That's the big black dog here. If widespread layoffs happen, we're going to have some trouble. I think the desperation borrowing will continue this trend of, the big number installment loans with the big interest percentage behind them is going to continue to go up. And I think people are going to realize exactly how powerful CRA is in the next 12 months, because they're doing things I haven't seen before.
Is that right?
They're pulling every lever that they can, except they still aren't leaning people's houses for tax debt.
And they're coming after people. This is what you talked about last year. You mentioned coming after them for CERB.
Yep.
So they're now more aggressive on the CERB, but now you have, the other point you mentioned, I've been doing 2 or 3 jobs, and those 2 or 3 jobs, if they make less, they don't get aggregated as you do when you file your full tax return.
Yeah. So if you owe 30, 40, 50,000 in credit card debts, like our clients typically do,
yeah,
and you got CERB, the first round of CERB was paid in gross dollars.
I know.
Nobody gave any of it back because they were desperate. So now CRA is saying, okay, well, you owe us $3,500. Okay, on top of everything else, plus I probably got an installment loan, and anybody who took the CEBA debt, the big business one, the 60,000 one, right? That's one they're going after like crazy. So
coming in January.
Yeah. And, they extended it all of 4 weeks. So thanks, guys. So, and I realized that there are people who paid them back. And so we have an unfair thing here where some people paid them all back, but some couldn't. But CRA is going after them anyway. They don't care. And if I was them and you were a corporation owner and owned a house, why wouldn't I put a tax lien on your house? I'll get paid eventually, and I'm CRA. I don't care if I have to wait.
Yeah.
So CRA is making a lot of waves, and I think a lot of people who've never owed tax before are going to owe tax, and it's going to be a problem on top of everything else. It won't be the only problem, but it won't help, right?
But from where you're going, you have a situation where the central bank raised interest rates, which squeezed people. That's government. You have government gave money to people, didn't explain to them that they were going to have to pay some tax on that, allowed them to get a second and third job, but has no mechanism to ensure that the tax being collected is indicative of the tax of the income being paid, and the individual doesn't even realize this. And so that third whammy, it's like, there's 3 strikes, you're out on most things. People are not going to be happy with the government, because when things go wrong, you don't look at yourself and say, well, I probably lived a little bit too high on the hog, and I used my house as an ATM, and I probably shouldn't have done that. But they're going to say, no, government's fault. Bank's fault.
CRA only teaches you stuff at the end. They don't teach you the stuff up front. There's no preventative measures with CRA, right?
I think there should be a mandatory class in every high school that's taught personal finance.
Yep, I have been lobbying that for 10 years with the Ministry of Education on completely deaf ears. So if anyone out there listening to this knows anybody in the
I'm working on it.
I'd love to hear from them.
All right, Scott. If there's any questions from anybody that you'd like, make sure Scott's covered pretty much everything. I'm going to just wrap it up then with the 3 questions I like to ask all my guests. Your favorite book?
Okay, well, nonfiction, I would go with a book called Dreadnought by Robert Massey. It's about the naval buildup prior to World War I. Doesn't sound interesting, but it really is. It's basically an arms race leading up to World War I between Britain and Germany. It's fantastic. Fiction, I would go with Blood Meridian by Cormac McCarthy, the late Cormac McCarthy.
Nice. Okay, and your favorite podcast?
Hardcore History with Dan Carlin is excellent.
Oh, wow.
Yeah, it's he has some really long, like 12-hour podcasts that are broken up into segments, bite-sized segments on big broad issues in history. He's excellent.
Why are you so fascinated with history? Because I've known you a while now, and I know you've referred to things in life that are happening today, and then you'll like go, well, you know what? This is not an unusual, because in other societies in history this has happened. Go ahead.
I don't know, probably because we occupy so little of history. I mean, humans themselves are a drop in the bucket in the timeline of, like we would, if you looked at a timeline of the world, we'd be a blip. We'd be like a 5-second blip.
Yeah.
And in that 5-second blip, like a lot of things have led up to where we're at, macro things. I like that stuff. I like kind of getting an understanding of how the hell did we get here.
Fantastic. And lastly, your favorite breakfast and breakfast restaurant.
I love this. My favorite breakfast is Eggs Benedict, because it's not something I would ever make myself. Too lazy. So
Okay.
if I'm out, I'm ordering something that somebody knows what they're doing is making. And my favorite restaurant is a place called La Clandestina. It's a Mexican joint in the Junction. Fantastic stuff. Like Mexican, like you've never seen. Even if you like Mexican, this is something else.
All right, everyone. Thanks, Scott. Keep trying to save our Canadian population here. Make sure that we keep them on the positive side of debt and life in general, because I think one of the things that, as I listen to all of this, the stress level, people's stress level has increased exponentially because of all these issues. And so you're seeing it in family breakup. You're seeing it in reactions on the street with protests, and everything's intertwined.
Yeah. I think I read something recently, and I really wish I could credit this to who said it, but I think it was Robin Williams who said, "Be kind, because everyone is dealing with something that you have no idea about."
We'll leave it at that, especially someone like Robin Williams, who we all know suffered immensely with mental anguish. And, the work that he did in comedy was way deeper than just making you laugh.
Absolutely. Yeah.
Thanks, Scott.
Okay, Anthony, thank you very much, and keep doing this good stuff that you do. I think this stuff is excellent.
Thank you.
All
Take
right.
care.
See ya.